Hi, this is Michael Fisher for SavingAndInvesting.com, and I want to briefly introduce the subject of inflation. Inflation is the percentage change, typically on an annual basis, in the price of goods or services. And so, for example, if we can look at an index like the Consumer Price Index and calculate how much that index has gone up over a yearly period. So, for example, if the index has gone up 5%, then that measure indicates that the prices of those goods that are in that index, in that basket, have gone up by roughly 5%. And inflation therefore measures how much more goods are becoming expensive in nominal terms. So for example, 5% inflation means that goods and services have increased in price by roughly 5%. And the reason that inflation is a problem, or that it's so carefully monitored typically by central banks, is that as the prices of these goods becomes more expensive, say by 5%, then the purchasing power of the money that we've saved or that we have becomes less. So $100 will buy less if the prices of goods have gone up by 5%. And so that is why inflation is such a carefully monitored item. And what analysts often do is they look at what a real return is on an investment. So for example, if inflation is running at 3% and we're getting a nominal return, i.e. the return that we see on paper of 8%, then the real return is only 5% because of the 8%, 3% were taken away by inflation. And so we only really had a return of 5%, i.e. our purchasing power due to that 8% return only increased by 5% because the remaining 3% were taken away by the fact that the things we could buy had increased in value by 3%. Now, so inflation, in other words, is the rate of change expressed as a percentage in the price of goods over a time period, typically a one-year period. With respect to inflation, economists generally agree that what causes inflation is strong growth in the amount of money in the economy, i.e. the amount of dollars that are floating around in the economy. So in other words, if there's a lot of money being printed or created in an economy, then that money is chasing less goods and less services effectively, so the prices of those goods will go up in order to because now there's more money chasing those effectively fewer goods and services. The other thing that can lead to inflation is a constriction in the supply of goods and services. So if there's too much demand for certain goods or certain services, then the price of those goods and services will increase as the same amount of dollars chase those goods and services which are becoming slightly more scarce. Now, the reason then in effect to keep inflation under control, economic policy plays a role, and in particular monetary policy, which is the policy of setting interest rates and controlling the money supply. So because typically governments and central banks don't want excessive inflation because of the resulting loss in purchasing power, there is a real effort, a concerted effort at a national level to keep inflation at a reasonable rate. And inflation typically runs in the area of 2 to 3%, or it has in the US and the UK over the last 75 years roughly. And those numbers are considered acceptable, whereas periods of very strong inflation of 3, 4, 5%, because of the loss in purchasing power and the loss in the value of dollars that we have saved, become a concern for governments and for central banks. And they use monetary policy to keep that inflation in check, or in order to reduce the inflation rate again by potentially constricting the money supply, either by raising interest rates or by lowering the amount of dollars or currency in an economy.